You and I are going to go over the USDA loan in great detail, but there's going to be a lot of information, so make sure you bookmark this video so you can come back to it. Stay tuned, and I'm going to show you how USDA will allow you to roll your closing costs into the loan. With that, let's get started. The first thing I love about USDA loans is that there's no down payment. A down payment can be a really big hurdle for a lot of people, so that's definitely going to be a plus. The second thing that I like about USDA is that the mortgage insurance premium is a lot lower versus FHA or conventional. A conventional doesn't do 100% financing, and then FHA always requires mortgage insurance, but it's a lot more expensive than USDA. Later in the video, I'm going to break it down for you so you can see it. So it's almost double what USDA is. And then conventional uses a completely different underwriting criteria, and the premiums are a lot higher. The third thing that I like about USDA is that the seller can contribute up to 6% toward your closing cost. So if you don't have the funds for the down payment and you don't have the funds for the closing cost, that is a huge benefit. Up to 6% should be more than enough to cover your closing cost unless the property purchase price is very low, because then the 6% may not cover everything, but I've never seen that in all the years that I've been doing loans. The fourth thing is the types of properties that you can finance with USDA. You can finance single-family homes, townhouses, condominiums, and manufactured homes. But the manufactured home has to be brand new. And when I say brand new, that doesn't mean newer, it means never occupied. Now, the ineligible property type for USDA are any type of property that generates income. So duplex, triplex, farm, ranch, hobby farm. Other property types that are ineligible are going to be barn dominiums, properties that have a lot of amenities, because typically the home needs to be modest with USDA. A swimming pool may be allowed. It just depends, so make sure you talk to your loan officer about that to go through the guidelines of what's required with the swimming pool. Some of the other things that are not allowed are properties that are subdividable. So if you're buying a property and it's sitting, let's say, on 5 to 10 acres, and by the way, there's no minimum or maximum acreage with USDA. It just has to conform to what's typical in the area. But let's say that you have 5 or 10 acres and you're allowed to subdivide that. If that's the case, USDA is not going to allow financing on that property. The other thing that you need to know is that with USDA, you can go up to the conforming loan limit. And this is where, in some cases, USDA is a lot more flexible than FHA is. FHA has county loan limits. USDA goes up to 806,500 as of the time that I'm shooting this video. But conforming loan limits change every year, or can change every year, usually around November. So if you go to this link right here to FHFA, they publish what the conforming loan limits are going to be every year. Okay, we're here on USDA's website. You'll notice right away that there's single family housing guaranteed and there's single family housing direct. Guaranteed is when you're going through a lender, direct is when you're going directly through USDA. There are some differences. One of the differences is that single family housing guaranteed has higher loan limits and higher income limits versus single family housing direct. If you want to know more about single family housing direct, you'll need to reach out to USDA. So the first thing you're going to do is you're going to go and you're going to click accept. Once you go into an accept, it's going to pull up a map of the United States, and you're going to have property eligibility. And basically what you're looking for is any area that has an orange or yellow, whatever color you want to call that, blotch. Those areas are not eligible. The areas outside of these yellow areas are eligible. Second thing is this is previous eligibility areas, and this is because some metro areas have grown in size. And so previously these were, and then now some of the areas have changed. Income eligibility is very important that you come in here and you check. You're going to want to go to the state that you're in. You're going to pick the county, and then you're going to fill in some information. It's going to tell you how much income you're allowed to make. If you make too much, you're not going to be eligible for USDA. All right, so let's get started. What I'm going to do is I'm going to focus on North Carolina because that's where I currently live. So let me zoom in here. As you can see right here in the main metro area, it is not eligible. But once you get out into the suburbs, there is eligibility. Now, this isn't necessarily rural. It is according to USDA. But if you zoom in closer, you'll see that there's plenty of properties. There's lots of amenities, strip malls, shopping. There's all kinds of things in these areas. But they do tend to be semi-rural. And you can pull up a Google Maps and look. So you can see all this. These are all subdivisions in here. These are all subdivisions in here. And there's lots of amenities. So don't be afraid when they say rural. All right, next thing, we're going to go to income eligibility. I'm going to pick North Carolina. Check Wake County. We're going to say that there's 2 people in the household. They have 1 child. Nobody's disabled. None of them are students. We'll say the child care expenses are $4,000 a year. And we'll say, just to keep numbers simple, we'll say that the income is $10,000 a month even. And now, any adult members bringing in any other income, that needs to be added here. So let's say you have another family member living with you, mother, mother-in-law, whatever, and let's say they have Social Security income of $1,500. We'll add that there, hit finish. The applicant meets the income limits for guaranteed. And it shows you right here, total annual household income, that would include the Social Security from the other family member. Then they deduct the $4,480 because of child care expenses. And this is what they're going to use to determine household income. The guaranteed rural housing loan in that county allows up to $140,600. So now, if you go direct, they only allow $97,800. Now what I'm going to do is we're going to change the county. And I'm going to show you how much of a difference it can be. So in Avery County, the applicant does not meet the income limits. And the reason why is because the max allowed in Avery County is $112,450 versus $138. So you've got to always check this at the very beginning before you make an offer on a property. You want to make sure your income is eligible. And you also want to make sure that the property is eligible. Now, typically, the loan officer is going to check your income eligibility before they issue a pre-approval based on the county you're looking in, but you're going to need to make sure that the property you're looking at is eligible. USDA loans allow you to finance the closing cost if the appraised value of the home exceeds the purchase price. You can roll closing costs into your loan up to the appraised value plus the upfront guarantee fee. Generally, closing costs are between 3 and 6 of the purchase price. I found them to be lower, but I'm also in an area that has higher priced homes. So what's really cool about this is a simple calculation that you can do with a calculator on your smartphone. So this is the upfront guarantee and annual fee handbook. And on page 11, it tells us that it's a 1% guarantee fee. That's what gets financed into the loan. And then the annual fee is 0.35. So the way you calculate it is you take your base loan amount. That's the loan amount before they add the 1% to it. And you multiply your loan amount by 0.35, and then you divide it by 12. Okay, so this one is FHA over here, and this one's a little bit more complicated because you have different down payment options, which you don't have with USDA. But for most people, they're going to put 3.5% down. It's very rare for somebody to put 5 or 10% down. So for most people, if you put less than 5% down, your annual is going to be 0.50. And then after 11 years, it could potentially go away if you have enough equity in the property. And then, of course, if you want to look at this chart, you can look at what it is based on loan to value. Now, most people also don't do 15-year fixed FHAs, but if somebody happens to do that, it's 15. So it's the loan amount times 0.15 divided by 12 versus 0.35. This is the only time that an FHA loan is going to be cheaper as far as mortgage insurance versus USDA.